Hello, everyone. My name is Angel Cartagena-Luna, and my final project analyzes whether refinancing my current auto loan will reduce the total borrowing cost and improve overall financial efficiency. So the loan began itself in March of 2024 at a 17.14 annual percentage rate with a 66-month term. After making around 24 payments, there are approximately, obviously, 42 payments remaining from the 66 months. Given that a current market rate significantly lower than 17% as of current, I wanted to determine whether refinancing would create a meaningful financial value. So the objective of this project was not to simply reduce the monthly payment, but to evaluate total remaining costs over time and using structural financial modeling, but also to evaluate the market and see if I could get potentially a lower APR. So, what is the business problem itself? The central business problem is whether refinancing at a lower APR would meaningfully reduce total remaining interest expense while improving monthly cash flow. So currently, if I continue the loan at 17.14%, which is really significantly higher than average market, the average market APR or the average finance APR, the projected remaining interest over the next 42 months is approximately $4,946. So the decision requires evaluating the cost under the current terms, which I have an APR of 17.14, but I also have max care with the car itself. And total cost under refinance scenarios, the impact of refinancing fees, and whether the savings justify the decision itself. So this makes a financial optimization decision rather than just simply a payment comparison just to see. For data collection, so for primary data, I use my loan agreement and payment history obtained from the lender portal of CarMax. That's who I have my loan through and where I obtain my car through. This provide the key rare variables, which include the APR, which is 17.14%, the remaining balance of $14,693, and the remaining term of 42 months. I have a current car payment of 467 and 60 cents. So $467.60, which includes max care as well. And for secondary data, I collect the refinance rate benchmarks from two federal credit unions and a commercial bank. So the two federal credit unions were Members First Federal Credit Union, which advertise rates near 6.04%, Heritage Valley Federal Credit Union, which advertise rates near 6.10%. To validate the broader market conditions, I also use PNC's bank refinance calculator, which estimates APRs between approximately 7.5% and 8.5% for borrowers with good credit, which include PNC to allow me to compare credit unions pricing to commercial banks pricing and ensure the refinance assumptions were realistic and not just something that was not achievable. So the models used, I applied four analytical models to evaluate the decision itself. So first, a loan amortization model was used to calculate the remaining interest under the current loan. The amortization model is essential, obviously, to the installment loans allocate payment between the principal and interest over time, and early payments contain higher interest components. Second, I used the scenario analysis rather than guessing at potential rates. I modeled refinance scenarios using published lender benchmarks. This allowed a comparison of how different APRs level affect total cost. And for the third conduction, I conducted a break-even analysis to account for refinancing fees, and also assumed refinancing fees around 500 to $1,000 and tested whether projected savings would exceed those costs. And finally, I performed a SWOT analysis to evaluate qualitative strengths, weaknesses, opportunities, and risks associated with refinancing. This combination of quantitative and strategic modeling provides a better understanding of decisions and decision frameworks. So for financial results, under the current loan at 17.14%, the remaining interest over 42 months is approximately $4,946. So at Members First, I found a rate of 6.04%, which monthly payments decreased to approximately $388. Remaining interest drops to 1,620 approximately, and total savings are approximately around $3,300. And to be specific, $3,301. And as you can see the different results based on the APR and the monthly range as well. So these results clearly show that the current 17.14 APR is significantly above prevailing market benchmarks, even after accounting for fees between $500 and $1,000. Both credit unions scenarios generate strong net savings, and the largest driver of savings is substantial reduction in interest rate. The SWOT summary. So for the SWOT analysis, it supports the financial findings. So the strengths mean it includes a lower interest expense and improved monthly cash flow, along with the weakness, which includes the fact that 42 months remain and limiting the maximum potential savings compared to refinancing earlier. So if I would have had refinanced earlier, it would have been a way better option just because I wouldn't have paid as much interest as I did from the beginning, from the get-go. And the opportunities include securing competitive credit unions, and improving overall financial efficiency, and obviously saving money as well, and not spending as much due to high interest. And threats could include refinancing fees, potential underwriting variabilities, and possible interest changes before approval. When combining both quantitative and qualitative analysis, the strategic outlook aligns with the financial results. So for the final recommendation, based on the analysis, refinancing is recommended if an APR is near 6%, and can be secured through a federal credit union, and the loan term is not extended beyond the remaining 42 months. So it'll probably be near 48 to 36 months. But further than that, would just prolong the loan itself and prolong the payment at approximately 6%. Refinancing fees reduce total remaining interest by more than $3,000 and lowers the monthly payments by nearly $80, which over time, that's a big deal. Even commercial banks rates near 8% provide meaningful savings compared to maintaining a 17.14% loan. And if refinancing offers exceed competitive benchmarks or include excessive fees, I think that maintaining the current loan or accelerating principal payments, that way I can pay the car off earlier, would be a more appropriate and better option. But overall, the data-driven evaluation supports refinancing as a financially sound and efficient, enhancing decision that will benefit me and benefit my cash flow. Overall, this project is concluded. Thank you.